Hi everyone, this is Mrs. V Chen. Welcome to my Form 5 Accounting Lesson 4. And today is 16th February 2020. And today I'm going to use another example, DSE example in 2014 to show you all the treatments and transactions in this question, all right? Okay, so here is the question in 2014. All right, so after giving you all the trial balance here, and then you have to prepare three things. The first thing is to prepare and calculate partners adjusted net profit. So that means the net profit here, net profit for the year given to you in the trial balance is wrong. So there are some errors and mistakes that we need to do adjustment later. Okay, and part B, so we need to prepare the partnership's appropriation accounts. And finally, to update the partner's current account. Okay, remember, whenever there is current accounts, that means capital account must be fixed. So again, this is using system number 2. Okay, so before I show you what we are going to do, now I already have part A, which is the statement showing adjusted net profit, and then we start with the net profit 165. Okay, which is the net profit before adjustments. Okay, and later on we need to do all the correction error to get the correct answer. This is the correct answer, adjusted net profit. So this is part A. Okay, and then I have my part B prepared here. So profit and loss appropriation account. So we start with net profit. However, look at this, 157,900, which is the net profit after correction all the errors and mistakes. So I get this from here. So adjusted net profit. Okay, and this is the original figure given to you in the trial balance, and which is before adjustments. All right, so this is part B. Okay, and finally we have the current accounts. Are you okay? Now I have already put some figures here to begin with in our current account from the trial balance. Okay, so look at the answer here. So capital is fixed because there is the current account. However, look at Abby. Abby has a debit balance in the current account. So that means this is a negative thing to Abby. So to begin with, we have 43,000 opening balance to begin with, and a positive balance, which is Bobby here to begin with. Okay. All right, since we have errors in the financial statement, so therefore we need to do correction for error. As according to point number 1, it says interest on the 9% bank loan for the quarter. So how long is a quarter? There are 4 quarters in a year, so it would be 3 months, had not been paid or provided for. Now here is the diagram for adjustment of interests on bank loan. So this is the timeline, and this is the financial year end. So a quarter, we have 3 months. So this is the date that we start to have the 9% interest loan. So this is 3 months. Okay, all right, so what is the double entry to that? Okay, so what is interest? Interest will be always a finance cost in the profit and loss accounts, so that we have to debit profit and loss, and this is interest on bank loan. Okay, so therefore we have to pay for interests. Okay, so if you look at the question again, here, had not been paid. So what do you call expenses not yet paid? We call that accrued interests. Okay, and this accrued interest will be a kind of current liability in the statement of financial position. Okay, and how do we calculate? So depends on how much we borrow. If you look at the trial balance, we borrow 280,000. This is a loan, so the calculation will be 280,000 times, what is interest rate? 9%. Okay, now something very, very important, which is the date. So since this is the date that we start to have bank loan, so it only lasts for 12 months, a year, and then now there's a 3 on top. Are you okay? All right, so this is the calculation of interest. So let me use calculator to calculate that. So that will be 280,000 times 0.9, and the date is very, very important, so times 3 divided by 12. Okay, so that would be 6,300. So this is 6,300. Okay, since this double entry has been omitted, all right, so therefore net profit here will be net profit here, the expenses will be understated and net profit will be overstated. So therefore we go back to net profit before adjustments. We need to minus what? That is interest on bank loan, and this is related to point number 1. And then you can also write down the step, which is we borrow 280,000 for the bank loan and interest rate is 9%. Okay, something very, very important. If you ignore the dates, and all your calculation will be wrong. So 3 months only. So, and then we minus what? So that would be 6,300. Okay? Okay, so after point 1, now we come to correction of error related to point number 2. So let us do some revision on goods sent to customer on a sale or return basis. And here is my diagram to explain to you about goods sent on a sale or return basis. So we are given this information with goods invoiced at 20,000, and the customer only accepts 80% of the sales, so that 80%, no problem, will be account of sales. But what about this 20%? Since not yet accepted by customer, we cannot count this as sales yet. But however, the mistake saying that all sales here being all recorded as sales, so you can see obviously sales will be overstated. So therefore the first error I need to adjust is sales being overstated. All right, so let us do double entry to correct the mistake. If sales is too large, we have to debit sales and affected the net profit, so, and then credit accounts receivable. Now don't worry about the names given to you. So we have accounts receivable, trade receivable, and debtors, which means the same thing. So if the question here, DSE question, use accounts receivable, you just follow accounts receivable. All right, okay, so that will be, so the steps will be 20,000 is the total sales. However, with 20%, this should not be sales, so the sales account is too large. Okay, so let me use calculator. So 20,000 times 0.2. Good. So that is 4,000 and 4,000. Oh, all right. So this is the first adjustment. However, we have not yet finished. And look at this 20%. All right. So what do you think about 20%? Since we already have the goods sent to the customer, so that it is not in our warehouse. But however, when we get inventory here, you look at inventory here. So how do we get inventory? We always get inventory by physical stock taking. Since this 20% is not included in our warehouse, however, we should include. So 20% inventory unsold should be included or counted as closing inventory. But however, it is not. So what do you think? So therefore, inventory will be understated. Okay, now the related double entry for inventory understated, and therefore I have to increase inventory, debit inventory. All right, and since closing inventory is too small, so this will affect the profit and loss account as well. Okay, now we need to do some calculation related to that. So be careful. What is the meaning of goods invoiced here? Okay, let me get a red pen. So goods invoiced means it is at selling price. All right, but however, the inventory in the profit and loss, the inventory as current assets in the statement of financial position should be always at costs. So therefore, we need to convert the selling price back into costs. And then what is the information given to us? We are given markup of 25% on costs. So how do we change selling price into costs? So here is the step. That will be 20,000. Okay, this is selling price divided by 1.25 back to cost, and now we have 20%. Okay, should be included as part of our inventory. Okay, so the calculation will be 20,000 divided by 1.25 to change that back into costs, and then times 0.2. Okay, so therefore we have 3,200. Are you okay? All right, so therefore this is the adjustments and explanation for point number 2. So therefore if we add them up together, so what will be the effects on net profit? So here, debit profit and loss by 4,000, and then here, oops, okay, so and here, so I matched the place wrongly. Okay, let me change it. So it will be debit inventory 3,200 and 3,200, and here. Okay, so debit profit and loss is negative. All right, credit profit and loss is positive. All right, so if we combine these together, oh, which side is bigger? The negative side is bigger, right? So bigger by how much? Bigger by the difference, which is 800. Very good. So therefore, the 800 here will be deducted from the area here, net profit. So less inventory, and which is the credit sales as well, being 4,000. And then here, oops, okay, so and here, so I matched the place wrongly. Okay, let me change it. So it will be debit inventory 3,200 and 3,200, and here. Okay, so debit profit and loss is negative. All right, credit profit and loss is positive. All right, so if we combine these together, oh, which side is bigger? The negative side is bigger, right? So bigger by how much? Bigger by the difference, which is 800. Very good. So therefore, the 800 here will be deducted from the area here, net profit. So less inventory, and which is the credit sales as well, being over, oh, sorry, inventory. Okay, after point number 1, now we come to adjustments of point number 2. Let's do some revision on goods sent on a sale return basis. Okay, so to explain to you step by step, here I have my diagram for point number 2. So we have goods invoiced at 20,000 and saying that we only have 80% being accepted by customers. Okay, no problem. So this 80% will be sales. But however, this 20% will not be counted as sales. So therefore, what is the error? Okay, the error is here. All things being recorded as sales, so you can see sales will be overstated. So the first adjustment, we have sales being too large. Okay, so look at the double entry. Sales too large, we have to decrease sales, so debit sales and sales affecting the net profit account, net profit and loss account, and credit accounts receivable. And don't worry about this. Account receivable, same as trade receivable, same as debtors. You just follow the name given to you in the DSE question. Here is accounts receivable, so we follow and use accounts receivable. Okay, what is the calculation? So that would be 20,000 times 20%. So this 20% not counted, should not be counted as sales. So okay, so if you use calculator, so that would be 4,000. Are you okay? All right, so and look at this, goods sent. So where is the goods now? Not in our warehouse, however in the customers sent out already. All right, but however since not yet accepted, therefore the inventory here. So how do we get inventory? Always by physical stock taking. Since we don't see these goods 20% included in our warehouse, however, we should also count this as part of our inventory. However, it is not counted because it is not in our warehouse. All right, we already sent this to our customers. Okay, so the related adjustment will be inventory being understated because we need to include this 20% of inventory not yet sold to the customer. Okay, double entry. Inventory too small, increase inventory. Okay, as closing inventory in the trading account will be also understated, so the profit and loss will be understated. So we credit profit and loss. This is about revision that you have learned in the first term. Now we come to calculation. All right, let me change color. Okay, so look at this, be careful. Goods invoiced at this much, so that means this 20,000 is at selling price. However, inventory should be always recorded at costs. Therefore, we need to change that 20,000 selling price back to costs. Okay, what information we need here? A markup of 25%. So therefore, divided by 1.25. So this is the cost. This is how we change selling price to cost. And now, which is 20%. Are you okay? So how much is that? Therefore, we debit inventory with this start by 3,200 and here is 3,200. Okay, so therefore the error in point number 2 consists of two parts. Now let us combine them together. So debit profit and loss, which is negative. All right, and then credit profit and loss, which is positive. Are you okay? So if we combine them together, so we have to do negative by 800. Are you okay? All right, so this is the adjustments related point 2. Okay, go back to part A. So negative deducts net profit because of point 2. Point 2 saying adjustment for goods sent on return basis. So we have 800 here. Okay. Now the final answer. So altogether we need to minus 7,100. Okay, so start with the wrong figure of net profits and after adjustment. Yes, very good. We get the adjusted net profit figure here. You okay? All right, now we have finished part A. We get the adjusted net profit after correction all the mistake, and then we are going to carry forward this into part B. So net profits. Now this time, no mistake and error included in net profits. This is profit and loss account. We always have these three things: add interest on drawings and minus salary to partner, and then we have interest on capital. Remember that in the previous lessons. Okay. All right, so let's start with the easier one. So the easier one here is interest on partner's capital. Now, whenever we have current, that means capital is always fixed. Okay, so that we can simply do calculation here. So less interest on capital, all right, means the firm has to pay, and then this is the calculation, and capital is fixed. So let me do some calculation, and then times 8%. So 12,000, and Bobby is 30,000, no, 300,000 times 0.8, and that is 24,000. All right, so since the partner is going to earn this interest on capital, therefore, when I move on to current account here, so I'm going to put Abby, 12,000 for Abby and 24,000 for Bobby, and this is what? This is interest on capital. Done. Okay. All right, next. Okay, interest on partner's drawings is charged at 10% per annum. So here, there is drawings. Where's, oh, drawings is here. Right, drawings is here. Remember, how do we where do we close drawings? Since there is current account, capital account must be fixed, so we close these drawings account into partners current account. All right, so this is current account. So 18,000 for Abby, 12,000 for Bobby, and now we have drawings. All right, so after closing drawings to the current account, and something also very important, which is about interest on drawings. So to remind you one more time, the dates here for drawings is very, very important. So if you ignore the dates, then all calculation will be wrong. Now here is the diagram to explain to you and the double entry. So the usual double entry for interest on drawings. Okay, so the firm is going to receive, so credit profit and loss appropriation accounts, and then debit current account to charge on the partners. So this is the amount for the drawing for Abby, which is 18,000. You can see up here 18,000. Okay, and the interest rate is 10%. Now the date is very, very important. Draw timeline. Okay, here is the timeline. The end of financial year ends, and the date for Abby, the drawings, is on 1st of March. Therefore, you need to calculate from here to here how many months. All right, so that will be 10 months. So here is 10 months over 12. So this is very, very important. If you ignore the data, all your calculation will be wrong. Okay, so the same situation goes to Bobby. And look at the date. The date is on 1st of September. So you count this, it should be 4 months, right? So be very careful whenever you calculate the dates. All right, so this is it. This is very, very important. You draw timeline, and to get rid of the careless mistake. Now I use calculator to work out how much is that. So 18,000 times 0.1 times 10 months only. Okay, so that is 1,500. And then another one for Bobby, 12,000 times 0.1 times 4 divided by 12, which is 400. So I do the same thing, 1,500 and then 400 for Bobby. Okay, now posting debit current account Abby. All right, Abby here, 1,500 because of interest on drawings. Okay, and 400 debit Bobby's current account 400, and then credit Abby, Bobby in the profit and loss appropriation account. Since we use the vertical form and credit means positive to the partnership, so therefore I will have to add this 1,000 and match the place. Okay, 1,500. Okay, what about the other one? 400. Okay, and what is the most important thing? So how many months? 10. So 10, 12, 4, 12. This is very, very important. If you ignore the dates, then your calculation will be wrong. So that will be 1,900. Am I right? Yes, this is it. All right, so finally we come to salary. So annual salary to Abby should be 60,000. Annual means for a year. Oh, however, something very special in this question, and actually it is quite similar to the previous question. Do you remember? So partner salary Abby. Okay, let me make adjustment here. So we always debit salary to partner in the profit and loss appropriation account, and the appropriation account goes for a year, so a year is 60,000. All right, so therefore Abby is going to earn this and receive in Abby's current account. But the point is, since we already have 20,000 existing in the trial balance, that means the current account already include 20,000. All right, so therefore we don't credit all. So we only credit the remaining. So how much is the remaining? So that will be 40,000. All right, and then credit this partner salary account, this partner's salary for this 20,000 Okay, to cancel this. Okay, so do you understand that? Now, if I go back to the double entry before that, so what is the double entry here? The double entry made in the trial balance will be debit partner's salary, Abby. So 20,000. That's why you have this item in the trial balance. So obviously, the firm should credit current account for 20. So therefore, Abby's current account, this includes this. All right, so actually, if you do analysis again, this is step number 1. Therefore, debit partner's salary Abby. So that's why you see this. And then credit current, 20,000. So this current for Abby already include 20,000. Therefore, when we credit current account again, we don't need to credit the total. All right, so actually this part is similar to the previous question in 1987, the question I showed you before. All right, okay, so therefore here, profit and loss appropriation account less salary Abby should be 60,000. Always the profit and loss account for how long? For a year, so 60,000. And credit current here, Abby not 60, only 40,000, and that will be what? Salary. So why 40 instead of 60? Because here already include 20 salary entitled to Abby. So this is it. Okay, now we have finished all the adjustments related to 2013. Okay. All right, so the final things. So after we have corrected the net profit and entered all things in the profit and loss appropriation account, we get this positive figure, and this positive figure will be share of profit. Okay, to share by Abby and Bobby in this ratio. So so the calculation will be 63,800 divided by 5, and 2 part goes to Abby, so 25,520. So the remaining will be 63,800. The remaining will be 38,280. Okay, very good. So we close this share of profit, and this share of profit is a good thing to the partner. So credit partner's current account with share of profit, so 25,520, so 38,280, and the description is share of profits. Okay, so after we have posted everything into the current account, so finally you will get this closing balance. All right, so that's all about this question. So the conclusion is to remind you one more time, and even though this is a partnership question, but we have 2 points related to correction of errors. All right, and you have to do correction of errors step by step. That is the first thing. And then another special thing is about the treatment of salary to partners. Since we already have 20,000 included, so when we credit current, we don't credit the total, we only credit the remaining. That is the second thing. And also the third thing, okay, so dates for drawings is very, very important. If you ignore the dates, that means your interest on drawings, the calculation will be wrong. So very good. Okay, so thank you for watching my video. I'll see you next time.